Welcome everybody to the Folkestone Education Trust HY18 results presentation. All participant lines are currently on mute. Following the presentation, we'll open the call for questions. To queue for a question, please press star 1 on your telephone keypad. Thank you again for joining us today. Your presenters for today are Nick Anagnostou, Folkestone Education Trust CEO, and Trevor Butcher, Folkestone Education Trust CFO. I'll now hand over to Nick to begin the presentation.
Good afternoon and thank you for your attendance today. I'm Nick Anagnostou. I'm joined by Trevor Butcher, our CFO. Hopefully you've got a copy of our presentation there in front of you. We don't propose to reread it to you, but rather to touch on some relevant points through the presentation and hopefully take questions at the end. Just turning to the first slide there, the presentation we've prepared is provided to give you an overview of FET's financial performance, as well as a detailed overview of the operating sector, its prospects, challenges and opportunities. We hope that'll put you in a good position to understand our prospects for 2018 and beyond, as well as to being able to assess the effectiveness of our strategy and how we intend to generate further long-term returns for investors. We've said before that FET is a little bit of an endurance event as opposed to a sprint. That should bring a relatively greater predictability through a careful mix of planning and development, some risk and adherence to our strategy. The first half's activities should indicate that we've maintained that discipline and that the results are now landing. A 10% growth in EPU, followed by an almost 7% growth in NTA, as well as more opportunity via careful selection in the development pipeline. We've implemented what we believe is a profitable yet sustainable development program for growth. It gives us the best possible product and drives earnings well into the future. We expect FET could have gross assets of about $1 billion by the 30th of June this year. Just turning to slide 3 and looking at the dashboard. A quick overview of the dashboard. I think reasonably similar to last year. Statutory profit, including unrealised valuation gains, was $55.4 million. That's a fall on the previous corresponding period, reflecting a slowing in valuation yield compression from that period. EPU's up to 8.3 cents for the half. It's almost up just on 10.7%, and we will reconfirm our DPU for the full year at 15.1 cents as forecast. NTA was $2.51 at June 17, now up a further 6% to $2.67. That's a total of about 13.6% increase over the full calendar year. For the 3 core competencies of our portfolio, asset and capital management, we see about $16.5 million worth of centres completed, and that was 3 centres, of which a further 2 have been completed since the 31st of December, and we expect another 5 in addition to those to be completed by the 30th of June. We've purchased another 7 development sites, so the development site program really continues to do very well for FET, particularly with respect to future earnings growth, and that pipeline is really now starting to build towards about $156 million of contracted sites for further development into childcare. We're continuing our recycling program, so we sold another 7 centres at an average yield of about 7.5, and that provided about 11% premium to carrying value. In terms of asset management, we've talked before about the stickiness of tenants and the goodwill value of their leaseholds relative to our freeholds. We've had 14 of 14 options renewed for the year, which is not necessarily a surprise to us. We've got a few more to do for this year, all of which we expect will most likely be renewed, tenants taking up their 5-year option period, of which is 5 years in advance. The WALE continues to grow, and there's a fair bit of work done by our asset management team with respect to new and existing leases that have been not just renewed but completely rewritten. So we're picking up a 15-year term as opposed to a 5-year extension of those leases. In terms of compression, we've had about 20 points relative to about 80 points of compression in the previous corresponding period, and that's indicating a little bit of a slowing there in terms of yield compression, which is consistent, I think, with the rest of the real estate markets. Rental growth has been strong, 4.8% achieved on our market rent reviews relative to our 5% cap, and about a 3% overall like-for-like rental growth over the period. Capital management, which Travis will talk to you in more detail, remains stable, 4.2% per annum cost of debt. Gearing has dropped to about 26.8%, and we've got 51% of our debt book hedged. Just turning the page to slide 4, in terms of FET's performance, distribution and capital growth remain our key objectives, obviously relative to risk. Distribution growth is now about 18% over the last 3 years, and unlike previous periods before that, it's more driven by organic growth, particularly through the development pipeline, rather than being reliant on less expensive debt. Both distribution and NTA levels have been enhanced with respect to not only the rent reviews that we've been able to achieve over the last 2 or 3 years, which do have a compounding effect given FET's lack of vacancy and certainly as long-term WALE, but certainly in terms of driving further rental growth, which we'll talk to you in a little bit further down into our presentation, and also NTA growth with respect to the margin that we're managing to achieve through our developments. Just turning to slide 5, in terms of the childcare overview for the year, we went into reasonable detail at the full year HY17. We're not, in terms of what's occurred over the last 6 months, we're not necessarily deviating away from any of the commentary that we gave you then. In fact, I think our commentary was reasonably effective and accurate. What is occurring in the market now is that it is simply more dynamic. There's new supply in the marketplace, which ultimately I think in a moderate sense is a relatively good thing for childcare, and that's simply driven by the fact that it drives innovation, it drives operators to work a little bit harder, it actually lifts the ultimate overall quality of the end product. As we've said to you before, there's certainly a very distinct correlation between quality and profitability in the sector, and what we would expect to see probably over the journey, particularly now with parents having the choice, and certainly there's a flight to quality that we're seeing in the sector because there's a little bit more supply at the top end. Parents are now very simply asking the question, well, if you want me to pay $140 or $150 or even $100 a day, relative to people's income, you need to be doing something pretty good to achieve that. We've talked to you before about operators who invest into their businesses, invest particularly into their people and their programs. They are the ones who are winning out at the moment. I think the industry is probably now starting to refocus back on actually maintaining their existing occupancy, building their existing businesses with less of a focus on future development sites within their particular precincts. In terms of industry metrics, we've talked before about profitability of the operators. We're not seeing any significant change in that. We've given you probably a reasonable estimate of about an 18% margin. We seem to see most of those operators maintaining that margin. The first half of the year can be, in some locations, a little bit more difficult to continue to achieve that rate, simply because occupancy builds towards the end of the year. But that's a very seasonal aspect and very consistent from childcare from year to year. In terms of government funding, we won't touch on this in any great degree because we did last time, but certainly the funding package. I think we're now 6 months or probably less than 6 months away from that. It's due to be implemented on the 2nd of July this year, and we'll talk to you in a little bit more detail with respect to where we think that might impact childcare and our portfolio. We've talked before about supply. Probably the one thing there with respect to supply that I haven't already mentioned is that we're seeing that the debt funding for a lot of small developments or developers is starting to get a lot tighter for childcare. That's probably not an unpredictable part of the real estate cycle at this point in time. Just turning now, I'll pass over to Travis to talk you through the financial results and capital management.
Thanks, Nick. Good afternoon to everyone. Key points to note on page 7 are, as Nick touched on, statutory profit of $55.4 million is down by $13.7 million. And this is largely a function of a $13.4 million decrease in property revals. We had, across the portfolio in this half year, we had 20 basis points of compression and $33.9 million of revaluation uplifts. This compares to 47.4 uplift and 40 basis points of compression in the prior period. Distributable income for the half was $21 million, up 12.3% on the prior period. EPU for the half was 8.3 cents, up 10.7%, with distributions paid for the period of 7.55 cents, representing a payout ratio of 91%. This payout ratio is lower than the historical ratio, primarily due to the impact of the capitalisation of interest of $1.1 million on the development pipeline. On the HY18 annual basis, we'll reassess the level of this payout ratio based on activities in the second half, which will include disposal activity and also the financial impact of increasing the maturity of the debt facilities, which we're looking to do. FET continues to have a clean and strong balance sheet. The benefit of the property and security revaluations has resulted in the NTA uplift to $2.67 per unit and a gearing level of 26.8%. Moving to page 8, key points to note here. Distributable income's up $2.3 million or 12.3%. This is a function really of three things. 3% like-for-like growth in lease income from the existing portfolio. Secondly, the benefits from the acquisition and development program has added an additional $1.3 million of income for the half, net of disposals. And thirdly, as I touched on previously, the improvement due to the capitalisation of interest of $1.1 million in relation to the development site portfolio. Moving to the NTA bridge, key movements here are property revals, which we've talked about previously, up 13 cents, and also gains of 2 cents from the security portfolio. And this has largely come from the uplift in our 15% holding in the Folkestone CIB fund, which during the half had new long-term leases put in place with the State Government of Victoria and had a subsequent valuation uplift from there. Moving to page 9, and the FET's capital management. There's not really significant changes here since 30 June. Gearing sitting at 26.8% based on those revaluation uplifts, which is still below the 30 to 40% long-term range that we've got. So that provides FET with significant headroom and capacity for growth. We've currently got $62 million undrawn in the facilities. And when you combine that with some of the disposals we're looking to do over the next 6 to 12 months, plus funds retained from the DRP, we've got plenty of funds to fund the existing development pipeline of $73.8 million, which is the required funding over the next 2 years. Overall cost of debt is unchanged at 4.2%, and we've got the staggered hedging positions, as you can see there, with an average of 51% hedged through to June 2022. Key focus for us over the next 6 months will be the extension of $77 million debt tranche that we have in June, maturing in June 2019. And really one of the things we're looking to do on the capital management side is look at longer term debt options for FET. Given with the predictability of income that FET's got, plus the long WALE of 9.2 years, it really makes sense that we increase the debt maturity for FET. The current debt maturity is 3 years. If we can increase that, and really it comes down to cost-benefit analysis, just looking at getting that right blend between debt maturity and the cost of that. I'll now pass back to Nick to cover the operational performance.
Thank you. Just moving to slide 11, which is a reasonable summary of some of the asset management and property management initiatives together with our development site. Most of these facts have probably already been covered at one point as we work through in terms of some of the numbers, but it's really probably some of the messaging here. We're continuing to sort of in the top left-hand corner there to continue to see valuation gains. We'll talk a little bit more about those on the next page. But certainly that 20 basis point improvement is a slowing over the 80 points that we had in the first part of last year. The overall passing yield is still about 6.5%, and that's still quite an arbitrage to the general market that we'll talk about a bit further on. The recycling underneath that of existing assets is a healthy thing for FET. It certainly does protect a little bit of downside risk into the future, and they typically tend to be sites that we look at today and say that they might have getting close towards maximising their end value, certainly relative to land value, which is one of our key focuses. Still an 11% premium to book, so I think the messaging that we're providing here with respect to NTA and certainly the directors' valuations that we undertake is there is a level of conservatism there, and so there's probably still a little bit more room even relative to the current market in that NTA number. The 14 5-year options that were exercised obviously go out for 10 years, as you know, given the 5-year notice period. That really does highlight the stickiness of the tenants and the value of their goodwill relative to the length of their lease, and that's why we end up with essentially what is our 100% acceptance ratio of those option take-ups. The development sites, which add value on all fronts to not only to income and WALE and quality of the portfolio, and particularly with respect to underlying land values and picking up on the thematics of population and economic activity. We've now got 19 which we own. We've contracted a further 7 which are unconditional. Excuse me, 2 more development sites with heads of agreements with an end value of about 7.6 million, which takes you to 156. We've also got a fair bit more coming through the pipeline. So that's why my comment earlier was that we expect to get towards that $1 billion mark potentially by the 30th of June this year. The 3 that were completed gave us a good end value of 16.5 million, yield on cost of about 7.5%, and that's relative to sort of buying on market at 5.5%. And in the case of those 3, a relatively healthy margin of about 25% on cost. Just turning to the next page, in terms of asset management, one of the key things that we've been trying to do for FET is move away from the sort of the heavy weighting that we had towards CPI leases. So the box in the top right-hand corner very clearly shows that even for HY18 moving towards HY20, a reduction in the number of CPI leases, and that's really the compounding impact of all of the good work our asset management people have been doing in converting older leases. So where there's a lease assignment or an opportunity to review that lease that's currently in place, we've been moving them either towards a more fixed or at least a minimum of a 3% increase, which we think is about the sustainable mark for the childcare industry. There were 10 of those that we did during the year, and as you can see there on the 4th line and the top left-hand corner, indicated a 17.3% increase in rent payable. So we still think we're very clear that that FET's portfolio probably still remains, to some extent, under-rented with respect to the current market, and that's not necessarily a bad place to be because there's always a little bit of upside that we think we can capture at some point in time. To give you a bit of a feel for the tenancy mix, again, not a huge amount of difference here. You'll probably see a reduction in Good Start with respect to the proportion of our portfolio that they occupy. That's not reflective of Good Start whatsoever, really just a reflection of all of the other things that we're doing with a multitude of tenants. One of the key things that we are focusing on with our new tenancies, whether that's a development site or an existing property, really is about now focusing on the best quality tenants that are out there with respect to the quality of their operations. A little bit of occupancy that we see at the top of the marketplace is forcing operators to get better. The choice 3 years ago, parents were very happy simply to have a place. Now parents are saying, I've got a choice and tell me why I should be paying you $160 a day in some locations. And that's forcing operators to get better. So that innovation that typically comes from that is something that we're focusing on. It's certainly part of our development pipeline moving forward. It's not simply about any longer finding what you might think is an undersupplied location. It's now very much a quality factor that needs to be taken into account. Turning to valuations on page 13, you'll see there the average yield across the portfolio is about 6.3%. Taking into account that the average yield of market transactions was about 5.5, that's a reasonably good indicator, I think, of the arbitrage that still exists between our portfolio and the rest of the market. Keeping in mind the rest of the market's probably more weighted towards metropolitan locations as opposed to regional. There were simply a lot of transactions yet again for the year of about $300 million worth of childcare real estate on the eastern seaboard. That is now very much a consistent number year on year and proves up, I think, if anybody still had any concerns with respect to the underlying level of demand out in the small investor market. On average, if you look at our yields, certainly I think there's been a change here with respect to our property yields, and it's probably reflective of the marketplace. Victoria has a yield on the top right-hand corner there in the box at about 5.7%, which is actually now under New South Wales. And I think that's probably reflective of the fact that with the significant amount of population growth, particularly under that 0 to 5 category in Victoria that we've had over the last 10 years, even with a significant amount of new supply, we think most of that new supply, assuming that it is well placed in terms of location, will simply be absorbed reasonably easily, given the level of population growth. WA and Queensland have also seen a little bit of contraction. You'll see a negative number there for New Zealand. That's reflective of exchange rate changes over the last corresponding period, as opposed to a reduction in value. The leaseholds tend to be a little bit of a roller coaster at times with leasehold valuations. That tends to be more driven by the individual valuer as opposed to unnecessarily any changes in the market movement or the market value of the leasehold improvements. Just turning to the next page in terms of the development pipeline, this is really where we start to provide the greatest level of earnings growth into the future for FET. Certainly at this point in time with a pipeline of about 156 million, and that excludes what we have completed up to the 31st of December. From here on in, we expect to be able to add, without adding any further developments to it, about $10 million in forecast rental and over the next 2 years. The pipeline there is spelt out in the chart. We've got 2 sites there, 3 sites that were completed. $16.5 million at South Marang, Wyndham Vale and Williams Landing. 2 sites that unfortunately are not proceeding. Both of those will be sold. We have a recovery process there with respect to our capital and which is guaranteed from the viewpoint of our expenses to date. So there's no downside risk with respect to, or limited downside risk with respect to those 2 assets. And then we've settled another 44. A couple of columns along on the waterfall chart there, another almost $42.5 million worth of contracted sites takes us to, very comfortably 156, and potentially we're thinking that with other things that we can see in the pipeline in very well located, undersupplied and probably poorer quality of the existing operators' locations, we tend to think that could start to climb towards 200. In terms of the development profile on page 15, you'll see there at the top, Hyatt and Northcote are the 2 properties that have now been completed. Hyatt is open for business. Northcote opens for business next week. And they are absolutely 2 standout childcare centres that we've constructed. The feedback that we've had on both of them, particularly the one at Northcote, is excellent, simply from people that we know driving past. It stands out. It's got great prominence, a little bit of a landmark in that particular location, and we understand that it is oversubscribed 3 times with respect to its demand from the local residents. Hawthorn, directly under that, is soon to be opened, probably over the next 6 weeks, and then thereafter there are going to be another 4 that will be completed by 30th of June, and they're very much on time with respect to our existing timeline. And will be at no additional cost to FET with respect to any delays. I think Hawthorn's probably about 3 months over where we expected it to be. The remainder of the portfolio there, you'll see it is heavily weighted towards Victoria. There is no apology for that, and that's simply because it's where the population is growing the greatest in the 0 to 5 category. That might change in future years, and our focus might be more towards Sydney, which is not. It is already Sydney, but certainly more towards Sydney. And even at the moment, Perth is getting a lot of attention simply because of the level of growth there in the 0 to 5. Turn to the next page, and you'll see very clearly there on the top right-hand corner of page 16, although it is a reasonably long period of time to compare 2008 to 2017, we've almost had a 22.5% increase in the number of 0 to 5s. What we've also seen, and I think it's not necessarily a surprise to us, but maybe a surprise to a few others, is that participation rate has tipped up yet again. So we're now at 37, almost 37%, as opposed to 35%, where we were, this time last year, or when the numbers that we had, which typically come out about a year in arrears, were when we looked at it 12 months ago. So that participation rate continues to increase, which means more people, even from the existing population level, are continuing to use childcare, and I think a lot of that is simply driven by the increasing quality of the operators and the innovations and the new programs that they're implementing. And that's why I go back to the comment that we made earlier around the fact that new supply, if in moderation, is not necessarily a bad thing. In fact, I think it's quite a healthy thing. Looking at some of those numbers there, we've got a 9,350 more children in Victoria over the year to March 2017. So I don't think our focus on the Victorian locations, in fact, I think it suits perfectly what we expected might happen, and in fact those numbers, I must admit, are probably greater than we expected with respect to population growth. Just turning to page 17, supply. Interestingly enough, and I know we've mentioned this before, still got a few commentators in the marketplace talking about 1,100 centres. Certainly now the numbers are becoming a lot clearer with respect to the increase in supply, taking into account the participation rate increase and also the level of increase in the number of children in the 0 to 5 age group. We had 318 new centres in Australia over the last 12 months to the 31st of December. A little bit of a spike there, as you'll see in the bottom right-hand corner with respect to the timing at March 2017. And that spike is really driven by the fact that I think that's the time when centres really want to open their doors and open for business. Unfortunately, it's sometimes impossible to open it exactly at the right time that you want, and that's really driven by when you get your planning permit and how quickly you can start building. Essentially what you probably want to be is ready to open your doors in November or late November, early December, so you can market and then open. So those numbers there probably reflect not so much completions, but actually the issuing of a licence in a particular territory. If you look at the left-hand graph there, you'll see clearly that the number of centres has accelerated and probably seems to catch the number of children, even though those two measures are a little bit different on that graph. I think what that graph doesn't take into account is quality. And it doesn't start to differentiate between what we think might be lesser quality operators as opposed to higher quality operators, and those two factors now need to start being given more consideration as opposed to simply treating childcare as a commodity, which, as we know, it's not. Just turning to the following page, page 18, the government funding changes. I think generally speaking, overall, the market and the industry sees the changes as a positive. One of the unknown factors will be how it does actually impact on every individual parent or family group, and a lot of that will be driven by the level of income in their inside their family group, as well as the level of fees that they're paying. There is a little bit of nervousness in some quarters around what the impact of that might be. I think the very simple way to consider it will be, if we look at our portfolio, we have an average fee of about $95 a day. In that sort of bracket, we tend to think that the chances are that probably north of about 85% will be significantly better off. And that table that we've added there with respect to the current and the new funding gives you, what could be a reasonably typical example of the level of the changes. One of the key changes, in addition to those things, also is that in fact the operators will now be paid directly. So there's a level of minimisation of bad debt, and also just a simpler funding mechanism, which we expect will add a further efficiency. So overall, 2nd of July will be when that new regime comes into place. I expect there will be a little bit of noise at that point in time around the impact on particular families. I think generally speaking, yes, there will be some losers. There will be some winners with respect to simply the weekly income and the impact of the cost of childcare on the family units, particularly in this environment where we're looking at the cost of almost everything that we purchase at the moment increasing, and what I think is probably faster than CPI. Just turning to the outlook on page 20, I think generally speaking it's reasonable to assume HY18 remains stable. We're not seeing any particular knocks to the industry. The one thing that I think remained a little bit of an unknown was simply the level of supply. I think that supply is now very identifiable. We don't see that as being necessarily a bad thing with respect to providing a further impetus to the sector. In fact, we see it as very much a good thing. The developments that we're doing will continue to grow. We'll continue to do those. We're aligning ourselves and have always aligned ourselves, but a greater focus now on the best quality operators that we find in the marketplace. They're also the ones that typically tend to be attracted to what we build. Disposal of a small number of non-core properties into what's still a very strong marketplace is a good time to recycle, so we'll continue to do that. Travis has spoken to you in a fair bit of detail with respect to the debt. One of the things that we will be looking to and focusing on is simply the evaluation of that longer-term debt facility and maturity, simply to match our WALE and provide a little bit more certainty into the future. Portfolio management, we are at 100% occupancy, so we'll be seeking to maintain that, and we don't see any reason why that shouldn't be maintained. We've got 18 options to renew over the rest of the next 6 months, and 23 more market reviews to complete. We reconfirm our guidance at 15.1 cents. Possibility of a little bit of extra distribution in the tin at the end of the year. We will evaluate that relative to our debt funding costs associated with that, and other opportunities. That's the end of the presentation. More than happy to take questions from anybody.
Thank you, ladies and gentlemen. Welcome to the question and answer session. To ask a question, please press star followed by 1 on your telephone keypad and wait for your name to be announced. We'll now pause a moment to assemble a question queue. Thank you. Your first question is from Scott Hudson from CLSA. Please go ahead.
Yeah, good morning. Good afternoon, Nick. I was just wondering in relation to your comments around the EBIT margin across your portfolio at around 18%. Could you give us some insight of what that would be if you exclude Good Start?
Good question, Scott. I don't think we've actually done that analysis, and the simple reason is we tend to do it more on a locational basis rather than an operational basis. And it would probably be a little bit of a skewed statistic to pull sort of Good Start's portfolio out. Good Start operate for us across the entire spectrum from some of our best centres down to some that are probably in the bottom quartile. So yeah, I know I recognise I'm probably answering your question, but I'm not sure what the metric that you're trying to derive.
So their margin portfolio would be broadly similar of other operators across the space.
Look, their financial model is different. They are a full-purpose vehicle, and as a result, they as do all full-purpose vehicles, they don't pay tax, as one example. So but at the same time, they reinvest all of their surpluses straight back into the industry. So they're a very important part of it. I'd suggest that if we said 18% as a margin, generally speaking, I think it's fair to say that the for-profit, the not-for-profit or the for-purpose sector, has a lower margin than that.
Got it, thanks. And just in relation to, I guess, occupancy trends across your portfolio, could you give us some sort of indication of where, I guess, occupancy ended calendar year 17 relative to the previous 12 months, or even relative to the previous 12 months?
We're still compiling some of that information, so it's anecdotal what I'm suggesting to. I'd expect to see probably a 2% change in occupancy. It's probably a downward movement overall. I don't think people would suggest that that's an unrealistic number. And that's really driven by a couple of things. I still think we've got real pressures on the family unit with respect to cost. Would it be ideal if the new package had come in 1 July 17 as opposed to 18, but that hasn't happened. So that amount is the amount that is available to parents has been whittled away through lack of inflation on that number, but also simply through the cost of living. So that's why everybody's looking forward to the 2nd of July. Plus I think parents are trying to extend that utility of that money over the whole financial.
Got it. And then lastly, you mentioned sort of 308 new centres in Australia. Do you have any idea of how many closed last year?
That's a net increase.
That
318 will be a net increase because it's based on the number of licences issued at any one particular point in time. So, look, I'm only aware of. I'm not aware of a vacant childcare centre, but I did hear one childcare centre closing.
And you talk about sort of a moderation in the pace of supply over the next 12 months, given, I guess, the DA pipeline. What sort of level, what sort of number would you be expecting in calendar year 18?
Yeah, it's a good question. I think we'd be forecasting on that point, and I suggest we're probably seeing something probably closer to 200 as opposed to 3. A few people chastised us when we said we thought it was going to be 250 to 300 12 months ago.
Yep.
and told us we didn't know what we were talking about, and it's come in around that mark. Look, everyone is forecasting that number. There's no doubt. But I think having our ear to the ground, what we're hearing is that a lot more developers out there are now struggling with finance.
And that 200 would be closer to trend, you feel?
I think so. I think, and the hard part to really take in, if you're simply trying to match number of children and the number of licensed places, I think we'll all get it wrong. I think you've now got to, when we go into a location to say, would we put a new one here? Clearly, demand is an important thing, but you've also got to look at the quality of some of the operators, and that can actually be a real determinant, particularly for matching your development to the right operator. So it's skewed. You just can't do the sums of how many kids and how many places.
That's great. Thanks very much.
Thank you. Just a reminder, if you do have a question, please press star followed by 1 on your telephone keypad. So we'll just move to Louise Greig from Greig and Harrison Pty Limited. Go ahead. Thank you.
Hi, Nick. Just on your developments, the two that aren't likely to proceed, why aren't they proceeding?
Yeah, good. Louise, one of them is simply due to lack of being able to get a development approval that we were happy with. And councils now, and I think we pointed that out in one of our slides, have become, their discretionary criteria is getting harder and harder all the time, to the point that we think they're well and truly overstepping the mark. In that one particular case, the planner told us, I'm writing the permit for you. 24 hours later came a rejection of permit notice. So we think there's a lot of political influence at the moment inside of a lot of councils, which makes life a little bit unpredictable for us. The second one was simply a cost issue, and we got to that point where we were delayed with respect to planning, and then we encountered some difficulties with respect to substrata type issues around soil and foundation, and we've decided that project is probably no longer feasible.
Thanks.
Thank you. Our next question is from Jonathan Kriska from Petra Capital. Please go ahead.
Hi guys. Just a notice in the accounts there was a $1.1 million capitalised interest in there. I'm just wondering, is there been sort of a policy change in terms of how you're looking at your developments, and how should we be thinking about sort of forecasting those sort of numbers going forward?
Yeah, Jono, it's basically probably due to the increase in the development book. Like under accounting standards, if an asset takes longer than 12 months to effectively complete, you are required to capitalise that interest. So historically, we've probably had one, the book's been too small, and secondly, we've adopted a conservative position on that and haven't capitalised. But given the size now, we've had to effectively capitalise it under accounting standards. So I think your best way to look at it is almost using that Gantt chart that really tracks the costs of the development pipeline, and then applying the cost of debt to that to work out what that sort of add back would be, or what would be the amount that would be capitalised.
Okay. And secondly, seems like your MER's come off quite a bit, which is obviously positive. So I'm sort of calculating that on about 73 basis points using a combination of RE fees and other expenses. Is that a fair run rate from here now, or you see that sort of heading back up or further down?
Well, you've basically got your base management fees at 50 bips. So then on top of that, as your fund gets bigger, gross assets gets bigger, which we expect to, then that will come down, because you do have a lot of other sort of fixed costs, such as your audit fees, tax, custodian, those sort of fees, that as your fund gets bigger, they'll, as a percentage, will get smaller.
Yeah. Okay.
Thanks, guys. Jonathan, it's Nick. Just on that issue of MER, how do you value the added value, if you like, of the development pipeline in that MER?
Let me come back to you on that one.
Okay.
Thank you. It looks like we have no further questions at this time. I'll now hand back for any additional closing remarks.
Thanks for your attendance today. If you have any further queries, please contact our Investor Relations Manager, Lula Losey, or Travis and myself directly. We'll be in Sydney next couple of days and happy to catch up with anybody there if you want a cup of coffee or spend half an hour with us talking about FET. Thanks very much.
Perfect. Thank you, ladies and gentlemen. That concludes the Folkestone Education HY18 results presentation. Thank you once again for joining us today. You may all disconnect.